September 16, 2019, 9 a.m., New York. Overnight lending rates in the repo market, the circulatory system of global finance, suddenly spiked from 2% to 10%. Banks that need cash to fund daily operations can't borrow. The system is seizing. By 9:55 a.m., the Federal Reserve announces emergency intervention, injecting $75 billion into the market. The next day, another $75 billion. The day after, $100 billion. For weeks, the Fed pumps money daily to prevent total liquidity collapse. Most people never heard about this. No headlines, no panic. But inside the financial system, alarm bells screamed. Because for a few hours that September morning, the plumbing of modern finance stopped working. Here's what keeps central bankers awake. That crisis was a warning shot, and the threat is growing. By the end of 2024, shadow banking, activity operating outside traditional regulation, reached $256.8 trillion. That's 51% of all global financial assets, larger than the entire regulated banking system. And when something breaks in that $256 trillion network, regulators don't see it coming. By the time they discover which institutions are exposed, contagion has already spread. The question isn't whether shadow banking will trigger the next crisis, it's whether anyone will see it in time to stop it. Every financial collapse follows an identical pattern. Leverage builds invisibly, interconnections multiply unseen, and when one institution fails, the shock ripples through a network nobody mapped. Let me show you 3 cases where shadow banking nearly destroyed the system. Case 1. Long-term capital management, 1998. LTCM was a hedge fund run by Nobel laureates and Wall Street legends. It used mathematical models to make billions on tiny price differences in bonds. The fund started with $4.8 billion in capital, but here's the mechanism. LTCM borrowed $125 billion from banks and entered derivatives contracts worth over $1 trillion in notional value. Leverage ratio, 25 to 1. Nobody knew the full extent. August 1998. Russia defaults on its debt. Markets panic. LTCM's models assumed bonds would behave predictably. They didn't. Positions that were supposed to converge diverged violently instead. Within weeks, LTCM lost $4.4 billion, nearly all its capital. The fund faced liquidation. Here's why this mattered. LTCM had positions with every major investment bank. If it defaulted, forced liquidation of $125 billion in positions would crash markets globally. The banks themselves faced massive losses, not just from LTCM, but from identical positions they held. September 23, 1998. The Federal Reserve doesn't bail out LTCM directly. Instead, it organizes 14 banks to inject $3.6 billion to prevent collapse. The alternative? Systemic meltdown. The lesson regulators learned. One hedge fund with $4.8 billion in equity nearly destroyed the global financial system because its leverage and interconnections were invisible until it was too late. Case 2. Archegos Capital, 2021. March 2021, a family office most traders had never heard of lost $20 billion in 48 hours. Banks globally lost $10 billion. Archegos was run by Bill Huang, a former hedge fund manager. It held concentrated positions in tech stocks, Viacom CBS, Discovery, Baidu, using total return swaps. Here's the invisibility mechanism. Swaps are derivatives that give exposure to stocks without owning them. No disclosure requirements. Archegos built positions equal to 70% of GSX Tech Edu's outstanding shares, 60% of Discovery, 50% of IQI. Nobody knew. The fund used 500% leverage. When Viacom CBS announced a sharing offering, its stock dropped. Archegos faced margin calls. It couldn't pay. March 26th, banks began liquidating positions, $20 billion in forced selling. Stock prices collapsed 27% in hours. The losses? Credit Suisse, $5.5 billion, Nomura, $2.85 billion, Morgan Stanley, $911 million. Combined bank losses, over $10 billion. But here's the critical detail. Goldman Sachs and Deutsche Bank escaped with minimal losses. They liquidated faster than Credit Suisse and Nomura. The pattern? When shadow banking positions unwind, speed determines survival. The fastest banks dump positions onto slower competitors. Coordination becomes impossible because nobody knows who else is exposed. An independent investigation found Credit Suisse had breached internal risk limits on Archegos since spring 2020. Risk officers knew. They did nothing. Why? Because Archegos generated fees, and in shadow banking, profit beats prudence until catastrophe forces correction. Case 3. The repo market freeze, September 2019. The repo market is overnight lending between financial institutions. Daily volume, $1 trillion. Banks, hedge funds, and money market funds exchange cash for securities as collateral. It's invisible infrastructure. When it works, nobody notices. When it breaks, the system stops. September 16, 2010. Two events coincide, a large treasury auction and quarterly corporate tax payments. Together, they drain the banking system of $120 billion in cash in one day. Normally, banks with surplus cash lend to banks with deficits. Rates rise slightly, the market balances. Not this time. Post-2008 liquidity regulations required banks to hold minimum cash reserves. When cash drained from the system, banks hit their regulatory floors. They stopped lending, even though repo rates spiked to 10%, offering huge profit. Jamie Dimon, CEO of JP Morgan Chase, stated publicly the bank had cash and wanted to lend, but regulations prevented it. Result? Overnight borrowing rates exploded from 2% to 10%. The secured overnight finance rate, SOFR, jumped to 5.25%. The system seized. The Federal Reserve intervened immediately, pumping $100 billion per day for weeks to restore liquidity. But here's the warning. This wasn't a crisis. It was a routine cash drain during normal market conditions, and it nearly broke the system. Fast forward to early 2026. Repo rates are showing stress again, rising 5 to 8 basis points above normal. The Dallas Federal Reserve issued warnings, SOFR spreads widening. The system is operating with thinner liquidity cushions than in September 2019. The pattern? Each stress event reveals the system has less margin for error than before. So, why does shadow banking grow despite these near collapses? 3 reasons. Reason 1, regulatory arbitrage. After 2008, traditional banks faced stricter capital requirements, liquidity rules, and stress tests. Shadow banking entities, hedge funds, family offices, and money market funds face minimal regulation. Capital flows to where regulation is weakest. Since 2008, shadow banking grew from $60 trillion to $256 trillion. Traditional banking grew slower. Opacity by design. Total return swaps, repercussion agreements, and structured investment vehicles allow institutions to build leverage without disclosure. Archegos held controlling positions in companies without filing a single 13F form. Regulators don't see the positions until they collapse. Reason 3, interconnection without coordination. Shadow banking links traditional banks, hedge funds, money market funds, and corporate treasuries in complex webs. When LTCM failed, 14 banks discovered they all held identical positions. When Archegos failed, banks realized they'd lent to the same client under different names. The system is interconnected, but nobody maps the full network until failure forces revelation.
Current warning signs for 2026.
U.S. financial institutions have loaned over $1 trillion to shadow banks, repo market stress recurring, Federal Reserve balance sheet expanded 10.4% since September 2019 to manage liquidity. China, shadow banking activities closely tied to commercial banks, trust loans, entrusted loans, and wealth management products operating outside regulation. Total size, estimated $10 trillion. Europe, shadow banking holds significant portions of sovereign debt, money market funds, and asset managers interconnected with banking system. The Financial Stability Body, the global regulatory body, warned in December 2024, shadow banking's rapid growth poses mounting systemic risks. Data gaps prevent regulators from measuring true exposures. Translation: they don't know where the next Archegos is hiding. Here's the brutal mechanism at the heart of shadow banking risk. Traditional banks fail visibly, deposits withdraw, stock price collapses, regulators intervene.
Shadow banking fails invisibly. Positions unwind in derivatives markets. Counterparties discover exposures only when margin calls arrive. By then, contagion has spread through interconnected positions nobody tracked. When LTC collapsed, the Federal Reserve had hours, not days, to organize a rescue before global markets froze. When Archegos collapsed, banks that moved fastest survived. Banks that hesitated lost billions. When the repo market seized in September 2019, the Fed needed $100 billion per day to prevent systemic failure from a $120 billion cash drain. The ratio is getting worse. Smaller shocks require larger interventions. Margin for error shrinks with each cycle. Shadow banking isn't the problem, it's a symptom. The problem is a financial system that has built $256 trillion in leverage and interconnection without building the transparency or coordination mechanisms for failure. Every stress event, LTC, Archegos, repo freezes, proves the same pattern. Institutions build leverage invisibly. Regulators discover exposures only after failure begins. And central banks inject liquidity to prevent contagion. But each intervention creates moral hazard. Institutions know central banks will rescue the system, so they take larger risks. Shadow banking grows, leverage increases, interconnections multiply. The system becomes more fragile precisely because rescues prevent failure. And the next shock won't politely announce itself with months of warning. It will arrive like Archegos, invisible until the morning margin calls don't clear. The question isn't if shadow banking will trigger systemic crisis. The question is whether $256 trillion in hidden leverage can unwind without taking the entire financial system with it. History suggests the answer is no. The mechanism is mathematical. The pattern is predictable. The only variable is timing. If this investigation revealed a risk you didn't know existed, subscribe now. Every week, we dissect another blind spot in the financial system, showing you the patterns before they trigger the next crisis. Drop a shadow emoji in the comments if you're paying attention to what regulators can't see. This is financial forensics. We examine the infrastructure failures before they become headlines.